Jeff Park, the guy who Anthony Pompliano hired to run his Bitcoin treasury company, just wrote the obituary for the 4-year cycle and announced what's actually coming next. Now, in case you're not aware, Jeff Park is the current chief investment officer for ProCap BTC Treasury Company. He's also the former head of alpha strategies over at Bitwise. Park also worked for Morgan Stanley, went to Stanford, stuff like that. So TLDR, Jeff Park is one of Bitcoin's intellectual titans in terms of understanding Bitcoin in the institutional era. His article caught my attention because I think this question over the 4-year cycle versus something new forming up in the different Bitcoin cycle is the big question. So, given the thesis here and Park's sort of positioning in institutional space, perhaps it's time to take a good look at this theory and see what we can pull from it. So, Park's core thesis: the 4-year cycle is dead and a new 2-year cycle has replaced it, which is driven by fund manager behavior and spot ETF flows. So let's try to unpack this a little bit. Why is the 4-year cycle dead? Well, according to him, basically because 95% of the tokens have already been mined. When you combine that with the ETFs that can swallow or dump 5,000 BTC in a day, in the same amount of time that it takes miners to produce 500 BTC, halvings just don't move the needle very much anymore. In fact, over the last year, we've seen about 1 million BTC accumulated by institutional players, while at the same time, miners only produce about 150,000 coins. The halvings just don't move the needle much anymore. Fair enough. Now, what about his new 2-year cycle idea? Well, there's 3 big pieces to it. The first is that since the institutions are now driving Bitcoin's price, then we need to understand how the institutions operate, how they think, and how they act. Meaning the institutions aren't thinking about Bitcoin's price 10 years down the road, but rather they're thinking about what their portfolio performance will look like at the end of each year. December 31st is when clients get their profit and loss statements, when bonuses are calculated, and when some fund managers keep their jobs or get fired. The institutions judge themselves on yearly timeframes. And when it comes to Bitcoin, the number they want each year is approximately 25% return. So that's how the institutions operate and think, according to Park. So the second piece is this 2-year institutional cycle idea. Basically, Park cites an academic paper from 2011, which shows that institutions and hedge funds tend to collectively push money into an asset and then extract money out of it in 2-year cycles. That's the basic idea. The institutions largely move in packs, like a bunch of wolves, and the general timing from initial entries to last exits, according to the data, is about 2 years. Now, the third piece is the launch of the US Spot ETFs in January 24. This launch kicked off the institutional era for Bitcoin, and these ETFs are the primary vehicle for the institutions to get easy exposure to Bitcoin. Now, before we dive a little bit deeper into this theory, guys, if you're serious about trading crypto, trading Bitcoin, Solana, XRP, Ethereum, you need a good exchange, okay? You need to be on FEMX, the platform built for global traders. It's fast, it's secure, it has all the coins you actually want to trade, and has deep liquidity. I personally use FEMX for years because it just works. No nonsense. And yes, it's available to everyone, everywhere. That's you. You might need a VPN in some cases, but small price to pay for what you're going to get because they have some insane deals on right now. In fact, they're giving away up to $1,600 in cash. The more you deposit, the more cash bonus back you get. Plus, there's up to $20,000 in trading bonuses. Absolutely crazy stuff. This deal will not last for very long. Hit the link down below. Grab it before it's gone. Ask yourself the question, will you start taking your trading seriously and move to an exchange that's going to reward you? If the answer is yes, the link's down below. Now, if we combine all these 3 pieces together, just to repeat, institutions judge themselves on their yearly profit and loss, and they're targeting 25% returns of their Bitcoin investments. The second thing, the institutions are largely herd animals, and they move in approximate 2-year cycles. And number 3, the January 2024 ETF launch was the herd's gateway to get Bitcoin exposure. Now, if you combine all of this together, then you get Park's dynamic 2-year cycle, because basically the ETF inflows create batches of institutional buyers looking for returns with specific entry prices and specific targets, taking clocks tied to their yearly scorecards. So if Bitcoin doesn't appreciate fast enough above these entries, then the returns are eroding, even if the price remains flat due to the cost of capital and the other lost opportunities that they could have been taking advantage of. Or to put it another way, time becomes the enemy, and fund managers are faced with hard decisions at the end of each year as to whether they should lock in profits, average down on losses, or rotate out into other outperformers. This is all a little bit complex, but Jeff applies everything we just discussed to that chart here and recommends that we track when the big ETF inflows arrive. because those represent the big institutional buyers with their shared cost basis and decision points. So, for example, we know that there were massive inflows into Bitcoin ETF products February, March 24. Therefore, if we know the institutions loaded up there, which they did, then Park was asking us to think about what decisions they might be making here at the end of 2024 and again here at the end of 2025. And so, depending on their cost basis, their 25% profit target and current profit and loss was going to depend on how they're going to react in the current market situations. He calls this a dynamic 2-year cycle, meaning you want to account for all the major institutional flows as they come in waves. So, for example, there was another heavy round of major institutional allocation in Q4 of 2024, meaning when this batch of institutions who bought during this time period are assessing their Bitcoin performance at the end of 2025, it's a different analysis for them, as they're probably around break even in many cases on their investment or even slightly underwater as compared to the group that bought back at the beginning of 2024, who's 50% up or so on their Bitcoin purchases. So those are the main points of this thesis. And I think I captured the major takeaways here. But if you want to read it for yourself, here's that title and link one more time. So, and by the way, speaking of cool links and stuff like this, link right down below here for my newsletter. It's awesome. 180,000 plus people a week reading it. You go to those people. You get it 3 times a week. It's free. We have altcoins. We have macro. We have stocks and all kinds of cool stuff. Check it out. Link down below. You'll love it. Okay. Now, what are my thoughts about all of this theory here? First off, I tend to agree about the 4-year cycle likely being dead, although we are currently in the proving zone. If it's going to be correct, we're going to find out real soon. If it's going to be broken, we're also going to find out real soon. The mass is the mass, so it's difficult to refute, despite the bad price action lately. Second, this entire dynamic 2-year cycle idea is very interesting because, again, we're entering a new era with institutional money allocations that simply did not exist in crypto before. I do think it's a good idea for us to monitor when the big inflows hit and then to think about what might be happening at the end of each year in terms of institutional inflows, their cost basis, their current P&Ls, all that kind of stuff. So there's a lot to chew on here. And finally, as we move forward, let's keep this theory handy to see how price action continues to play out and whether the 4-year theorists have been correct and we have a horrific bear market in 2026, or if we are indeed entering into a new life cycle for Bitcoin, an institutional life cycle. Look, we're still very early days in terms of any news cycle, so we need more time to see how things play out. But I think what we discussed here is pretty good information to keep in our back pockets. Because again, we are in a new era for Bitcoin. It's no longer cypherpunk nerd money. It's BlackRock, okay? It's Vanguard. Literally the biggest financial institutions in the world are all in on Bitcoin, and it's changing the game. Thanks for watching.